All right. So we are going to start now with the webinar on multifamily financing. And James, you are the senior director over there, or one of the senior directors. I'm not sure how your hierarchy works, but over there, Old Capital Lending. And so I'm going to turn it over to you. I want to thank you first for taking some time to be able to be with us here and sharing with our group about multifamily financing and various things surrounding this. So I'm going to turn it over to you and let you take it away.
Yeah, thanks a lot, Dan, for having me on the webinar. I mean, in 2018, Old Capital did $1 billion in multifamily financing, and so we definitely know a little bit about multifamily financing, and I want to share some of that information with you guys today. So let's just jump right into it. So just a little bit about my background. I was actually born and raised in Houston, Texas. Went to school at UT Austin, did finance there, and then have lived in sort of the DFW area since 2006. Coming out of school, I worked for GE Capital and worked in their commercial real estate division as a loan underwriter. And so I was the person in charge of underwriting the loan, making sure it met all of our criteria, and then approving those loans and submitting it up to sort of our investment committee. So I did that for 8 years. And then the last 4 years, I've been at Old Capital originating multifamily debt. And so I've done over $500 million in multifamily loans, and my average deal size is right around $5 million. And so that is a lot of multifamily loans over the last 4 years. And then I also, similar to you guys, am an investor in deals. So since 2015, I've invested in 24 properties in DFW, Austin, and San Antonio, totaling about 6,700 units across 24 properties. So a lot of transactions on the risk side, on the origination side of loans, and then also as an investor. So hopefully I can share some of that knowledge that I've seen on loans and then also as an investor. And so I usually like to start the conversation off on debt with 3 questions. So number 1, is the property stabilized or distressed? So yield play or value play. Number 2, what is your experience with multifamily? So is it 5 units and up? How many of those properties have you done? So 4 units and under do not count in the lending world. So the 1 to 4 unit loans, they do not help with your experience in multifamily. And number 3, what is your net worth and liquidity? So that's going to be important. So think about these 3 questions, because every time someone sends me a deal, these are the 3 questions that I ask them. Okay. All right. So when most investors are looking at multifamily loans, there are really 3 main types of loans. Okay. Number 1 is a bank loan. Number 2 is a Fannie Mae loan. And number 3 is Freddie Mac. Okay. So let's start with the bank loan. So bank loan is going to be a recourse loan. So that means you're personally liable for any deficiency. Okay. It's going to be 3 to 5 years. It's going to have an amortization of 20 to 25 years, and it's going to typically be up to 75% of the purchase price. And the main thing here is that there's not going to be a prepayment penalty when you go to pay off the loan. Typically, it's going to be a step down prepay, so 3, 2, 1. So it's going to be either limited, or some banks allow no prepayment. So very different than your typical residential loan, where you get a 30-year fully amortizing loan and you can pay it off at any time. On the commercial side, it's going to be 3 to 5 years in terms of loan term, and then you might have a prepayment penalty at the end. All right, so that's number 1, bank loan. Number 2 is Fannie Mae and Freddie Mac. And these 2 are majority, so of the, let's say, 500 million that I've done in the last 5 years, at least 85% of the deals I've done have been Fannie Mae and Freddie Mac. So most people, they get into commercial, they want non-recourse debt, because as they get into larger and larger properties, most people do not feel comfortable signing a recourse loan of $5 million or $10 million or $20 million. So they're looking at Fannie Mae and Freddie Mac for their loans. So on the Fannie Mae side, the difference between the 2, both are non-recourse loans. So you're not personally liable for the difference if there is a foreclosure. But the main differences between the two, number one, Fannie Mae allows you to roll the rehab into the loan. So we'll talk a little bit more about that later. But if you have, let's say, $1 million in rehab for your property, you could get up to 75, 80% of that rehab money in the loan through Fannie Mae. Okay, so rehab's included in the loan. But on Fannie Mae, you need to be an experienced borrower, and the prepayment penalty is a thing called yield maintenance, which is something that we'll explain later, but it is more expensive than a step-down prepayment. Okay, so Fannie Mae, most people are doing Fannie Mae when they're experienced, and then they also want the higher leverage for including rehab in the loan. And then Freddie Mac, this is going to be, so I'm going to focus in on Freddie Mac small balance loans. So these are loans anywhere from $1 million all the way up to about $6 million in most markets. In top markets, it goes up to $7.5 million in loan amount. So these Freddie Mac small balance loans have pretty much the same characteristics as Fannie Mae. They're non-recourse, they're long-term loans, but you do not get the rehab rolled in the loan, and then you get a step-down prepayment. So it might be a 5%, 4%, 3%, 2%, 1% of the loan amount as your prepayment. So it's defined very easily. And they allow some new investors if you have third-party property management on the Freddie Mac small balance loans. So when you look at these three types of loans, this is sort of the funnel. So whenever someone sends me a deal, I think through, okay, what's their experience, and then what property or what loan is going to fit their bucket well. So I want to give you guys some examples of these three types of loans on recent deals that we've completed. So let's go recourse bank loan. So these two properties, Meadows, 32 units in Louisville, and then Alvin, Texas, Garden Gate. On both of these transactions, the occupancy was below 90%. And so I didn't touch on this. On the Fannie Mae and Freddie Mac side, they want stabilized properties. So that means 90% occupied for the last 3 months, okay? So both of these properties, for whatever reason, whether it was the operator, whether it was the market, they were not at 90% occupancy. And so these transactions both had to go recourse bank loans, and both of these transactions, the investors, it was their first multifamily loan ever. And so these worked super well for first-time investors, and both of these transactions, they've owned these deals for about 2 years now, and now they are going to sell these properties. And on the sale, they will not have any prepayment penalty. And so that's very important as you start looking at deals. If you think it's going to be a short-term hold, then you might look at recourse bank loans, especially if it's your first loan. Okay, second loan type that we talked about, non-recourse Fannie Mae. So both of these transactions, Wynwood in Dallas, 106 units, and in Toscana and Bedford, which is a suburb of Dallas. Both of these properties had been well occupied, so they were 95% occupied for the last 90 days or more. And then there was limited rehab, so they were already in good shape. You can see both of these pictures. Properties are in very good shape already, and the investors wanted to hold it long term. And so we both put on both of these properties, we put 10-year debt, 12-year debt on the property, and both of the investors on these deals had already bought multiple deals. So Wynwood, the person had already had 4 or 5 Fannie Mae loans. On Toscana, that person owned already 3 or 4 properties in DFW. And so these guys are experienced sponsors. They got, the best rate and a non-recourse loan on these properties. Okay, so now the last one that we're going to cover in terms of loan types is the non-recourse Freddie Mac loan. And so similar as Fannie Mae, you're going to have that stabilized occupancy. You're going to have limited rehab on these. So both of these properties, they're not going to roll the rehab in. But on Park at Woodland in Houston and then LaDonna Place in Wichita Falls, both of these transactions, the investors were new and they wanted non-recourse loans. And so Freddie Mac loans work really well for stabilized properties, no rehab needed, and then they wanted to hold the deal long-term. So both of these were new investors, and they got step-down prepayment, which was key. So these are some of the questions that I get a lot of times is, what third parties are needed to complete these loans, and then approval time frame, and then how long does it take, and then any other closing costs I should be aware of. So let's start with number one. So third parties, there's really 4 third parties that are key: appraisal, engineering, environmental, and these are ordered by the lender. Okay, so you can have a separate engineer or general contractor come out, but these are always going to be ordered by the lender, so you don't need to order these on your own up front, because the lender has specific requirements that it needs to make. So appraisal, engineering, environmental, those are about $5,000 each, and then the survey. And so most Fannie Mae, Freddie Mac loans will need what's called the ALTA survey, A-L-T-A, ALTA survey, and those cost about $5,000 as well. So number 2, receiving approval. So with the bank recourse loan, they're going to approve those loans right up front, because they are going to typically be more, they're going to be more focused on you as the investor. And so they're going to look at your balance sheet, your tax returns, your income statements, and then they're going to essentially approve it up front and make it subject to the third parties coming in and all of those checking out. Whereas Fannie and Freddie, they're going to order all the third parties. It's going to take 2 to 3 weeks for those to come back. Then they're going to submit the deal to their investment committee. So those usually take about 30 to 45 days once you get sort of loan approval. And then at that point, you can lock the rate. So Fannie Mae locks the rate towards the end of the transaction. And then Freddie Mac, actually, if you sign the loan application at that rate, they will lock that rate up front. Number 3, how long does it take to close? Fannie Mae is 45 to 60 days, and a bank is about 30 to 45 days. And so when you're putting in your LOI, make sure you have enough time. Like if you put in an LOI and say, hey, I'm getting a Fannie or Freddie loan, and you say, I'm going to close in 30 days, that listing broker or even that owner might look at you and say, there's no way you're going to do that. So make sure you have realistic timeframes. And I like to tell people, even though it says 45 to 60 days, that's sort of if everything goes right, everything goes smooth. So I like to have at least maybe one 15-day extension in your LOI as well. And then number 4, how much are closing costs? Typically about 3% of the loan amount is a good buffer to handle loan origination fees, third-party reports, legal, and title. And so that sort of gives you a high-level overview of the 3 types of loans, and then sort of the common questions that I get on the 3 types of loans. And so what I wanted to do now, though, is really talk about structuring your sponsorship group to qualify for those Fannie Mae and Freddie Mac loans. So the thing that we talked about previously was your net worth and liquidity is important, and then also your own multifamily ownership experience. And so I like to think of this as sort of like a puzzle, and you get to put it together as a general partner. You could have all the money, you could have all the liquidity, but most people do not. And so you have to put this together and structure the deal correctly to qualify for the loan after finding the property and also raising the equity. So the 2 on the bottom are important, but the top 2 are sort of what are going to qualify you for the loan. So let me give you an example. And a lot of people get stuck on this part of the process. And so I want to talk about it and give you an example. So let's say I just handed you a 100-unit deal, right? So we're middle of July, handed you a 100-unit deal for $5 million. And I said, all right, 60 days from now, you need to close this deal, right? So August, September 18th, you need to close this deal, and you have 60 days. Could you do it, right? So show up at the title company and close a $5 million deal. So number 1, you need the $1 million in equity, okay? So you're either going to put that money in yourself, or you're going to raise it from limited partners at 50, 75, 100,000 each and have the equity. And then my job is to get you the $4 million in debt. And so how do you do that, right? So the loan, the way you're going to qualify for that $4 million loan is Number one, the net worth of the group. So yourself, anybody else signing on the loan needs to be $4 million or higher, okay? Number two, your post-close liquidity needs to be greater than 10% of the loan amount. So $400,000 in this example, greater than the loan amount. So they're gonna look at everybody signing, and they're gonna ask for bank statements for the last 2 months showing cash in either checking, savings, or marketable securities, showing that post-close liquidity, and retirement accounts are not gonna account in this post-close liquidity. So this needs to be cash at close. And number three is, what is your prior multifamily experience? Okay, so Fannie Mae is gonna look at what other deals have you done? What other deals have your group done in order to qualify you, right? So if you do not have all three of these, you will not qualify for the loan. And so start thinking about how you put together your group to hit these three items on a deal like this, right? So you can change the numbers, but essentially it's the same thing on every deal. And so, we talked about, the last 4 years, essentially, I've done over $500 million in multifamily loans, and majority of the loans have been non-recourse, and a large percentage have been Fannie Mae. And we talked about Fannie Mae in detail because you roll the rehab into the loan, and if it's above, let's say, that $6 million threshold or $7.5 million threshold in some markets, so if you're doing a $10 million deal or $20 million deal, Fannie Mae is going to be your guy to get the loan. And the majority of the deals that I've done are really like your class B and C sort of workforce housing deals. And so Fannie Mae has been very aggressive. And so I wanted to talk about the Fannie Mae Box. So what are all the things that Fannie Mae is going to look at when you send them a loan? And let's talk through sort of how to go through that process. So these are sort of a snapshot of the things that we're going to be covering in the next couple slides. So the first thing people ask me is, okay, how is Fannie Mae sizing my loan? Like how do they even determine how much of a loan to give me, right? So in that prior example, the $5 million property, how do they even determine if you get a $4 million loan or $3.5 million loan? And so there's two constraints. Number one, it has to be max 80% loan to cost, right? So 80% of your purchase price plus your rehab plus closing costs. That is the absolute max that you can get. But then also the debt service coverage. So debt service coverage is your net cash flow divided by your debt service. So the interest and principal and interest payments that you have to make on that loan. So in this example that I show here, it shows the net cash flow of about $600,000 at the bottom of the chart here. So net rental minus your expenses, you get to about $600,000 in net cash flow, and divided by the debt service. So the debt service, principal and interest payment is $479, so you get to $125 debt service. And so that is what they're going to look at to size your loan. All right, so that's how they size the loan and determine how much you get. Second thing is around Fannie Mae's green program. So this came up in probably the last 2 or 3 years, and they are wanting people to do more energy efficient things to their apartments. And so they're incentivizing you to use their program by giving you a lower interest rate. And so you qualify by getting a 30% reduction in water or electricity, and then you get 30 basis points off approximately right now. And then you have 12 months to do these repairs. And so I think we have a slide here. So, okay, so this was a recent deal. And how did you get to those energy savings? Number one, on the water side, it typically is aerators and shower heads, and then sometimes toilets. And then on the next column, you can see on the energy side, we're typically doing lighting, interior lighting, exterior lighting, and sometimes smart thermostats. So that's how people are getting to that energy savings. So yesterday I was actually locking a loan, and the rate was about 4% on green and then it was close to 425 non-green. So that delta of 25 basis points was making a big difference in their returns, in their loan amount, and then also just their total return on the deal. So they were willing to do a little bit more in CapEx to get those savings. All right, next thing on Fannie Mae is Fannie Mae lends nationwide, okay? But they have an eye on certain markets that they, number one, either have a large concentration in, or they have a majority of the loan book in those cities. And so where most deals, let's say in Dallas, they will give up to 75, 80% of the purchase price at close on your loan. If it's pre-review, it can sometimes be cut back to 75 and even all the way down to 65%. And so in these pre-review markets, you just have to be careful and have the deal reviewed up front. So I'm gonna put this slide up here. This is Fannie Mae's latest pre-review markets. I highlighted the ones in red if you're in Texas or surrounding areas. I mean, the big one in Texas really is Houston. So Fannie Mae has a very large concentration in Houston. There's nothing really wrong with the market. I was originally from Houston. A lot of deals that get done in Houston, but they have that as pre-review. So you just have to be careful when you're underwriting deals in these markets for pre-review that, number one, you get somebody to run the deal by Fannie Mae up front, so you get sort of a feel for what type of leverage you have going in. And if Fannie Mae is only at 65%, what we've done on some deals in Houston, we've taken it the Freddie Mac route or the bank recourse loan route, and that allows you to get higher leverage on the deal. All right, so we talked about the box and what sort of fits in the Fannie Mae box, right? So loan amounts of $1 million, 90% occupied for 90 days, limited deferred maintenance, CapEx is typically under $10,000 a door. But I wanted to talk about some things that Fannie Mae, you have to go to Fannie Mae for approval for. And so number one, interest only. And so most lenders are allowed to give you 1 year interest only. But if you want more interest only, it has to go to Fannie Mae. So that's number one, interest only. Tenant concentrations. So this can come into student deals, military deals, employer concentrations. Any tenant concentrations, especially, people might be employed there. So in smaller markets where you see a large concentration of one employer, or if it's right next to a military base or right next to a university, that's got to be disclosed up front, because Fannie Mae does not really like that. So your leverage will typically be cut back if your tenant concentration is greater than 40%. CapEx, this is if you're doing a very large rehab, then most of the time Fannie Mae is going to limit the amount of rehab you can roll into a loan. So we talked about rolling some of the rehab into the loan. Most people are around $5,000 a unit is a good number for CapEx that Fannie Mae will allow you to roll in. And then also the last thing is scattered sites. So they really don't like putting together portfolios of one single family house here, another single family house here, a duplex there, a triplex there. They really like more buildings that are in one plot of land, one real estate tax parcel. They really don't like separated scattered sites throughout the property. So check with your mortgage broker on that in terms of waivers. And then in terms of some of the other things around the borrower and how you're going to manage the property, Fannie Mae really is focused on giving loans to U.S. citizens. And there's exceptions to this rule, but they usually like to see more net worth, more liquidity. They like to see that that person lives here in the U.S. and works here in the U.S. and owns a home in the U.S. and has been here for a while. And so you still have to request a waiver, but we've had no issues getting waivers. It just takes a little bit longer. So that's number one, U.S. citizenship. Bankruptcy and litigation. So if you have been involved in a bankruptcy or you're currently having any type of pending litigation, let the lender know up front. because if you do not, they will find it. So they're going to run all the searches on you. They're going to run your credit. They're going to run lawsuit searches against you to make sure that there's nothing against you. So bring that up front and just be able to explain the situation. And then third-party property management. So Fannie Mae really likes to have third-party property management, somebody who who manages, let's say 500, 1,000 units in that market, running the property. And you being sort of the asset manager, especially if it's your first deal. So if it's your first deal, then they really want that third-party property management. If you do 10 deals, 15 deals, and then you say, hey, I'm going to bring it in-house, I'm going to manage my 15 properties, then that's perfect. You can self-manage. But for the most part, most people, it's going to be better if you have third-party property management. So we talked about prepayment penalties, and there's really two types on non-recourse loans: step-down prepayment and yield maintenance. And most of them on Freddie Mac small balance is a step-down prepayment. So that might be 5%, 4%, 3%, 2%. They'll step down every year. And then yield maintenance is on Fannie Mae. And so if you can avoid it, I would avoid yield maintenance because it is significantly more expensive than step-down. But at some point when the loans are above $7.5 million, you cannot get step-down. And so you have yield maintenance. And so I'm going to attempt, so step down is pretty straightforward, 5%, 4%, 3%, 2%, all the way down of your loan amount. And you know exactly how much you're going to pay once you hit that year. Yield maintenance is very different. Yield maintenance, the best advice that I can give is there's a website called Defease with Ease. And defeasance is a very similar process to yield maintenance. Defeasance is a little bit more expensive because you're actually replacing the loan. But yield maintenance is essentially all your payments that you owe. So let's say you take out a 10-year loan on Fannie Mae, and in year 5 you're like, okay, I want to prepay this. I'm going to sell the property. Okay, you sell the property, you have to pay off this loan. It still has 5 years left on the loan. So that investor who bought that loan is expecting interest for 5 more years. And let's say your interest on your loan was 4%. But the treasury, the corresponding treasury, is 2% at the time. So you, in essence, have to pay that investor almost double what your loan amount is in order to get that prepayment penalty off. So this is that's a little bit confusing. Sorry about that. But so let's look at this example. If you can see this chart, it just basically says, all right, if you did a $3 million loan, and then let's say 3 years into it, you decide, all right, I'm going to pay it off. This prepayment yield maintenance penalty you can see is close to $500,000. Okay, and so that gives you an example of after 5 years, when you still have 5 years left on the loan, instead of it being a step down prepayment where you're paying 5% of the loan or 4% of the loan, this is almost like 10 to 15% of the loan that you're paying as a prepayment penalty. And so definitely take that in consideration. Yield maintenance is going to give you a lower interest rate at the time you close on the loan, but you will have a bigger prepayment penalty. Okay, so we talked about when you put on a Fannie Mae loan, the next thing is around supplemental loans. And so this is a pretty unique aspect of Fannie Mae because let's say after you buy the deal this year and 3 years from now, you're looking at, okay, should I sell this property or should I refi this property? And let's look at the sale. So you can sell the property. The person buying your property can assume your loan and put what's called a supplemental, which is a second loan on the property, up to 75%, which is great. There's actually been a lot of assumptions in the past couple of years that we've worked on. But the second thing is also, let's say, look, I love the property, I love the location, I think there's a lot more upside in the deal, but I want to get my equity out. And so let's say you did that $5 million deal, you bought it, you got a loan for $4 million. Now you've improved the rents, improved the value, let's say to $7 or $8 million. You can go back to Fannie Mae and say, can I get a supplemental loan of, let's say, $1.5 million? And they will size it. It's going to be constrained on two things. On cash out refinance, it's going to be 70% loan to value, and it's going to be debt service constrained at 1.3. So that's higher than your typical 1.3. And then if your property qualifies, then you're able to get a supplemental loan at that time while maintaining your original loan. And so you could have that first mortgage of $4 million, and then you put that supplemental loan of 1.5, and you could return all the equity to your original investors and still own the property. So that's a very powerful thing with Fannie Mae loans that most other lenders do not allow. So that covers Fannie Mae loans in detail. I wanted to cover a couple things just to get a little bit more information about what we do. Number one, if you have not heard the Old Capital podcast, we're close to 1 million, and we just passed 1 million downloads on the Old Capital podcast. So we've been doing it for 4 to 5 years now. We put out 2 a week, basically interviewing every person that you need to know in the multifamily space. So check out oldcapitalpodcast.com. Number 2, like our Facebook page. So I think we usually record sort of monthly lunch and learns, any speaker series, anything like that, you can see live on our Facebook page. And then our big conference. So we have one conference a year here in Dallas. Last year we had about 700 people at AT&T Stadium. First year we had about 500. We had Rob O'Neill speak. Last year we had Roger Staubach speak. And then this year we're going to have another big keynote speaker. So if you want to learn about multifamily, especially investing in Texas, I created a promo code for all you guys. So you can go to oldcapitalconference.com, and the promo code is MFIN to get 50 off there. So in terms of next steps, definitely education. Start with the education. That's why you're on here. But subscribe to the podcast, like our Facebook page, come out to the conference if you can. And then in terms of, setting up time with me, I usually have you complete personal financial statement to really go through net worth and liquidity. And then you really just need to start underwriting deals. And once you see a deal that you think makes sense, send me, T12, rent roll, offering memorandum, purchase price, and then we can put together a debt term sheet that makes sense, whether it's Fannie, Freddie, or recourse bank loan. And then, use that to start making offers. And from there, you can close the deal.
Awesome. Well, thank you so much, James, for being here and sharing your information. I want to open it up to everybody for those of you who have watched this and maybe have some questions for James before we let him go. So if you have some questions, go ahead and find your chat box there and type it in there, and we will go through those. I have a couple of questions for you first. And so one of the things that, everybody always has questions about is around the experience level, right? Because obviously there's ways to gain experience with the lenders using certain people. Certain lenders that are fine with, newer investors, the smaller bank loans, bridge loans, various things like that. But when it comes to the experience, is the experience really around just multifamily, or is it in managing a large budget that might be similar, or owning businesses that you know how to run a business? Because at the end of the day, you look at these types of assets and you're not really buying real estate. You're buying a business that just so happens to be attached to real estate, which makes it very, very nice.
Right.
So what is it that they actually look for if maybe you don't have any experience at all with any type of multifamily assets?
If you have no experience, they typically like someone to sign with you.
Okay. So
bringing somebody on who has multifamily experience already, especially around Fannie Mae. On the Freddie Mac side, the Freddie Mac small balance loan side, they are more comfortable with a brand new person coming in, but they're not going to give you the keys to the car on the first one. They're going to want a third-party property manager in there who has experience. And then whereas an experienced investor might get 80% leverage 5 years interest only, you as a new investor might get 75% leverage in 1 year interest only. So they're gonna scale it back a little bit. So you still get the loan, but it's not going to be the same terms as a super experienced investor.
So are you typically seeing better terms for experienced investors that have that experience level, even though they might have net worth and liquidity? If they have that experience component, they can get a Fannie loan. Are they getting better terms because of that? And is that one of the, and what I guess what is the main reason why Fannie might not like it versus Freddie small balance being okay with it?
So Fannie and Freddie, even though they're both non-recourse government agencies, they are still in competition with each other.
Mm-hmm.
And they have different boxes and they compete head to head, sort of. And the main thing, on those, and the first part of your question, absolutely. Experienced investors get better loan terms. That is because there's two components of that. Because almost all of these deals in terms of interest only right now and in terms of pricing, so pricing your interest rate, you're having to go to Fannie Mae to get a waiver. And so when you go to Fannie Mae, they're reviewing the entire deal, but they're looking very heavily at the sponsor of the deal and the sponsorship group.
So another question's coming in here from David. He said, what type of software do you use to analyze deals from the lender's perspective?
So from the lender's perspective, multifamily is super, super easy. All you really need is an Excel sheet that calculates your debt service. So it's as simple as that. So we can go back. I don't know if you still have my screen up.
Yep, it's up.
So if you go to this slide around sizing loans, this is all they do, right? So they have a T12, they have a T3, and they're going to go line by line and underwrite each one of these revenue items. So, right, net rentals usually on a T3 annualized, other income on T12, management fee, 3%, 4%, depending on the size, payroll, utilities, insurance, taxes, and they're going to get to a net cash flow number. And once they get that net cash flow number, they're going to say, okay, based on this, you get this loan. And, the borrower's strength is going to determine the interest rate and interest only, but this is going to determine the size of your loan,
mm-hmm.
right? And so in terms of software, it's not that complicated for multifamily.
Because from the lender's perspective, they don't really care about returns for investors. They just care, is the debt going to get paid?
Is the debt going to get paid? And they are looking, so Fannie and Freddie, I would say, 75% of the weight of the decision is on the property.
Yeah.
Because they're a non-recourse lender. Whereas on the bank recourse side, it's probably 50-50, right? So 50% on the personal, 50% on the property.
Mm-hmm.
They're looking very heavily at the property. And if you just have come into multifamily recently, you don't realize how great the loans are, and then also how much easier it is to underwrite compared to office deals, retail deals, industrial deals. So when I was at GE, that's all I did was other commercial property types. And you'd have to look at, all right, when does this tenant lease roll over? How much are they paying? What do you think we can lease it up at? How much tenant improvement, leasing commission do we need for the space? Mm-hmm. So it was very cash flow driven all 5 years. Whereas Fannie Mae is really looking at in-place income and pro forma expenses on how you're going to run the deal.
One thing that I have a question in here on, I'm trying to cherry pick some of these questions because we're getting a lot of questions. So this is great. So if you want to go back to that slide with your contact information on it, James, that way, if after the webinar we didn't answer your question, there's two things you can do. You can take it to the closed Facebook group for the Multifamily Investor Nation. James is a part of that group. He can respond to your questions on there. I have a link there that I put in the chat box for those of you who might not be members of that group. You can click on it and join it, and that way you can continue this conversation. But If you want to reach out to James afterwards, there's his email there. You can email him directly as well as his phone number. So some of the questions that might be a little more specific to you, I probably won't answer those questions today. And so if we don't get to your question, reach out to James and he'll be glad to answer those with you. When it comes to short-term rentals, like Airbnb type rentals, things like that, how does Fannie Mae and Freddie Mac, account those into the underwriting?
So we've seen them. So it depends on how you're going to show it in the P&L. A lot of people will just put that as sort of other income and sort of allocate. I have not financed, like, let's say in Arlington, right next to AT&T Stadium, there's a small 20 unit and you do 20 units all Airbnb. I have not financed anything like that. So that probably is not going to fly. But if, let's say, you have a 200 unit deal and you allocate 5% of the units to Airbnb, that's not a problem. That's really just like a furnished unit. And because you could turn it back to a regular unit very quickly. Mm-hmm. Fannie Mae is more concerned about if there's a large concentration of any one thing, right? So for whatever reason, if it shuts off right away, the reason they like multifamily is they have a diversified tenant base. And as soon as you say, all right, 50% is this one corporation, and that corporation can shut it off in one year, they don't like that.
Yeah.
Yeah.
No, and it's the same thing with any other type of groups, whether it be, all, military or, other types of specialty, they want to make sure that they know that. And there's some limitations on that as well from what I've heard.
Absolutely. Yeah. Yeah. We've looked at, there's a couple military bases sort of down in San Antonio and then also sort of in between, just north of Austin. And so they're just a little bit more careful in those markets, just because if all these people get deployed, they have the right to end their lease. And all of a sudden 30% of your tenant base walks out the door. Mm-hmm. So you just have to be careful on those.
Yeah. Another question here is a lot of companies are advertising no money down or doing loans as acquisitions of the LLC. Can that be done?
Say that one more time.
A lot of companies are advertising no money down or doing loans as acquisitions of the LLC. Can that be done? I think it's more like, can you do a no money down loan, with these types of assets?
So as in no money down, as in no equity, you think?
Yeah.
You can, but I would say it is very dangerous, because this is not, so a lot of people who, let's say they bought single family homes, they might be got a hard money loan, and then 2 to 3 months later they turned it over and went to conventional financing. Like, that's how a lot of people get started in single family. But in multifamily, if you go out and get a very high leverage loan, like we ran into a group that was from California, they basically put 3 or 4 very high leverage loans, and they could not turn the property around fast enough to pay that debt. And essentially all that work that they did for 2 or 3 years, the lender just took the property back because it was a short-term loan. It was high interest. So Fannie and Freddie are, 4 to 5%. A lot of these no money down loans, you're at 10 to 15%. And there's almost no way for that property to even survive. Or even for you to make any money if you are in that loan longer than 6 months. I mean, it just, you have to turn that property very quickly. And, most of the properties that I work on are sort of that $1 to $10 million range. And it takes 18 to 24 months to turn these properties around. And you just can't, it's just, I would not recommend it. I mean, most people are bringing 20 to 25% of the equity. And most people are in this a little bit longer term. So this is not just sort of like your get rich quick stuff on the multifamily side.
Sure.
Yeah.
Question here about, Fannie and Freddie. Do they lend on things other than multifamily? Do they do like mixed use or office building or retail, things like that?
So there's always got to be a large component of multifamily. So,
Okay.
You've seen some of these mixed uses in sort of the suburban centers or even city centers where it's like maybe 10% retail, where they got like a Jimmy John's or, a dry cleaner or something on the first floor. That's fine. Fannie Mae can do that type of stuff. but a majority of the income has to come from multifamily. And they do other types of multifamily. So if you do like mobile home parks or senior living, they do those types as well. But our focus really has been on sort of really your market rate multifamily. There's just so much of that's what they're really focused on.
Mm-hmm. Question about net worth calculation. Can it include the primary residence that they have, the equity in their primary residence and retirement accounts and other non-liquid equity holdings in businesses?
Yes. And so net worth is they're actually pretty lenient on that. And, essentially you send in your personal financial statement, you sign it, and you attest that this is correct. The thing that they are super, super strict on is the liquidity. So that 10% of the loan amount, they want 2 months of bank statements, has to be in your name, it has to be cash or marketable securities, and it has to be very recent. So that is the part that they are very, very, very strict on compared to the net worth. So as long as the net worth looks reasonable, then they're gonna take it at face value.
Mm-hmm. Jamie has a question here. Could you talk a little bit about underwriting on the exit and how the yield maintenance can affect returns?
I wish that was a easier. that is a very difficult question because my best advice is to go back here. I'll go back to that site. If you do not have this site, this is probably the best site that I've ever seen. The fees with ease. And what you can do is plug in your loan and plug in when you think you're going to sell it, and then also plug in what you think the interest rate's going to be. And so those two variables make it hard to actually predict, because what's funny is some people listed deals at the beginning of this year and they thought, okay, my yield maintenance penalty is going to be $500,000. But then interest rates have dropped 30 basis points in the last couple months. And so their yield maintenance penalty went up, right? Because they're having to replace their loan, which was, let's say, a 5% interest rate. They're having to replace their loan with treasuries. And so it's actually a tricky calculation that until you get the actual payoff from your lender, you will not know that number on the yield maintenance. You can only really estimate it. And so most people do not underwrite their prepayment penalty in their 5-year cash flow. And I think there's two schools of thought. One is, well, I'm not going to sell it at that time unless I get a certain number in terms of my residual, and that's already going to bake in my prepayment. Or they're saying, all right, I'm going to sell it, and whoever is going to buy it, they're going to have to assume the loan, right? So those two assumptions are made, because I have never seen a 5-year cash flow and somebody say, all right, well, my yield maintenance calculation in year 5 is going to be $500,000 and reducing their proceeds by that amount. I've never seen that.
What are the minimum loan amounts for Freddie and Fannie?
$1 million is Freddie Mac small balance.
And that's the loan balance, right?
Yes, loan amount, yes. And then Fannie Mae can go down to $750,000, but I would not recommend anyone really go below $1 million, because just the cost, the paperwork, everything around it. And a deal that's $750,000, you're either going to love that deal and you're going to buy something bigger, or you're going to hate it and you're going to want to sell that deal. Yeah. So I would not want to put. I really don't like doing anything under $1 million because it's probably not going to be worth it to do.
Yeah. Well, thank you so much, James, for being here. I know there's still several questions we didn't get to have answered, but that gives people a good reason to reach out to you and ask some more questions for you directly, and also gives us some conversation pieces to go to our closed Facebook group and start that conversation. So if you have a question, go in there, tag James because he's part of the group and he'll respond to you there. And so thank you so much for being here. I'm going to go ahead and type in here the link again for the closed Facebook group. So if you're not part of that, go join it. And one of the other things that I'd like for you to do too, if you're listening here, is to go to the closed Facebook group and make a post that talks about your experience and what you learned today here on the webinar with James. And again, tag him in it so he knows that you made those comments, and he can see and kind of hear some of the feedback from this. So it also lets other people that maybe didn't jump on know kind of what they missed. So go there and kind of share maybe one or two different golden nuggets that you can share with the closed Facebook group and those who were not able to join us. So thank you again, James, for joining us, and looking forward to having you back again to talk about multifamily financing on a future webinar.
Thanks a lot, Dan.